Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, go through some tweets that I'm retweeting or sharing, and I'm going to give you my financial opinions around it. It does drive real close to what my opinions are. And some of these, I share opinions that are opposite, so I can talk about them later. And then some of the opinions are exactly what I think. And I'm going to go into these a little bit because I think they are, they're true, and they work. And I'm gonna give you a bunch of my opinions around it. So again, if you want to follow me, you can follow me at finding_finance. And if you guys need any help, definitely check out the finding-value.com website if you need any help with anything stock market related or investment related, if you want to learn how to invest. And these are my opinions coming up around this stuff and what I teach on the website. So Michael says the biggest returns come at the turn of the trend, not in the middle of it. That means to generate big returns requires a leap of faith. You won't learn about markets from FinTwit, that's financial Twitter. You learn about it the hard way, purposeful studying and work. So the thing that I'm focusing on is the biggest returns come at the turn of a trend, not in the middle of it. And I completely agree with that, 100%. The question is, how do you know what the beginning of the trend is? How do you identify that beginning? What do you use? We can use a whole bunch of different tools that I use to get us in early. And there's always companies, not always, but there's a lot of companies that are still lagging, that haven't taken off yet because of the sectors they're in. They could be energy service companies. They could be energy service companies that service other energy service companies. We'll call it the tertiary energy service companies. So when we look at this, I'm just going to kind of walk through the process of kind of how I do it and what the value is in learning this stuff. It's a process. And what's important is if you understand the process, you can replicate the returns. It's that simple. The process is, it's not looking at a chart and saying, oh my God, the chart has this pattern. That's part of it, but that's not the sole thing. I'm just going to kind of backtrack and give an example of what happened. So technical charts are created by humans interacting with each other. The question is, what conditions in the markets cause humans to interact certain ways that lead to specific outcomes? So let's just give an example. Inflationary environment, humans behave differently. They sell money out of bonds, they sell money out of stocks, and they put money towards commodities and precious metals, generally under inflationary times with increasing interest rates. That is part of the thesis of the channel, and we can figure that out by using ratios. Ratios tell us where the money is, where it isn't, and how it's flowing. That is what gives you the returns. So what I want everyone to kind of figure out, and what I try to teach on the website during those question and answer sessions and all that stuff, is you have to connect the dots. It's not about, I put my money in investment, I hope and I pray, and I make a bunch of money. No. This is calculated. It's more of trying to put the odds in your favor for a desired outcome that you want, which is making money. So it's more like, where's the money at? So we figure out where it's not at. In order to make money, you have to be invested in things that people are not talking about, that people are not interested in, that people, they just don't care about that sector. The thing that you really want to look at is what is going to cause money to rotate into that sector. So the money, where the money is all at, that's where money's going to flow out of, and it's going to flow to the money where the money is not. And we want to know, what are the market conditions for that to happen? Market conditions changes the rotation of money and how it rotates within the sector and what people do with their money. If inflation comes, people sell bonds, they sell stocks, and they put it to something else. We want to be in that something else. We don't want to be in stocks and bonds during an inflationary period when rates are increasing. Then we have to find out, when are those conditions going to change? When is it going to go to a disinflationary period? And people are going to argue to death about that. But generally speaking, we can see that using ratios and how money's flowing. And the way that I do it is I buy something that's very cheap. I buy and I look at the deficits of the commodities themselves. And then I also look at the technical analysis, the way that the patterns are behaving and giving me non-biased feedback. That's the only way I know to get in there, to get into something that is very early, that gives you the big returns. Big returns being 20, 30, 40, 50, 100 baggers. That type of return. I'm not talking about 40 or 50%. Putting zeros on the end of that is what I'm doing. But that's my approach. And obviously, if you guys want to learn that, you can check out the website. So there's that. We've got Chinese oil consumption is poised to hit a record this year. Daily demand will reach an all-time high of 16 million barrels a day after contracting in 2022. Now, I just want to bring something up, and it's obvious to me, and I just want to see if make it more obvious to everyone else. Put it that way. So oil demand in China is seen at a record in 2023, but let's go back 20 years or so. So about 20 years ago, they were at like 5 million barrels a day. They're up here at above 15 million barrels a day. And they're increasing their consumption of oil quite rapidly. My question to everyone else is, what's going to reverse this trend? Tell me what's going to reverse that trend. And they're going to say, oh, electric vehicles. Go research and figure out how much electric vehicles are going to have to be built to reverse that trend. Can they build enough? Do they have enough materials in the world to do it? Now, if they don't, and I don't think we do, at the rates that the adoption rates that what most people think, ask yourself this question. All right? Do you think that we can double our oil production? Do you think we can hit 200 million barrels a day? Most people, I'm going to guess, are going to say no. So no. All right, well then, how long is it going to take for India, China, and all these other countries to really ramp up their consumption of oil? How long is it going to take to basically have the demand want to double the oil production? It's probably pretty quick. Well, if we can't double our production and we can grow and the demand is going to grow to something that maybe we can't produce, what do you think that's going to do to prices? What do you think that's going to do to prices? It's probably going to go higher, right? So that's the way that I view things. I don't view things like I'm going to worry about a recession that's going to happen in 1 year. Okay, so you're going to kill a little bit of demand. So what? What happens after that? Ride through it, buy the dip, ride this dip higher. I think we've got some serious issues coming up in energy, and we got to invest massively in it. And yeah, I know where the money's not going. It's not going into oil and fossil fuels. So they're going to try to do some other method, and it may or may not work. But guess what? What if it doesn't work? I know this stuff works, but what if that doesn't work? Whatever they're trying to go to. You know how much of a price spike you're going to see in this stuff? Oh my God. It's going to be like 2021 on steroids when they're not releasing from the strategic petroleum reserves. At least that's the way that I view it. So here's U.S. home prices are falling on a month-over-month basis for the first time since 2012, even as inventory levels remain tightish. I really wanted to share this with everybody because this is where the anomaly is happening. So this is a chart, and what this is your months of inventory inverted, and this is your return month-over-month price. So when we look at this, I said 6 months is basically your break-even point. So here's 6 months, right? 6 months going across here. If our inventory is less than 6 months, we've never had a down month-over-month time frame, except for 2022. And that's where I was dumbfounded. I was dumbfounded because I looked at history, I looked at this scatter plot, and I said, look, if inventory is less than 6 months, we've never had a down month-over-month price decline ever. But guess what we had? Of course, the markets humbled me and we had some declines in our month over month for real estate, even though the months of inventory are below 6 months. That has not happened. But I will say this. We have had an insanely fast increase in the affordability of homes due to interest rates that we have not seen before. In the 1970s, those interest rates went up about they basically doubled. They went up 100, 200%, somewhere in that range. We went up from a very low level, at least the Fed funds rate, to a very high level. And our mortgage rates also went up quite dramatically. But this is the data that I was looking at, saying, I don't think we're going to get a price decline if inventory remains low. Again, I was humbled by that because we did see some price declines, even though our inventory remained very low. 6 months is the line in the sand. That's when we can potentially have some negative month over month. That's generally what's happened historically. And then when you get above 10 or 12, you're definitely in bubble land. So we're not in bubble land, but we're having price declines, which is an anomaly in history. It is an anomaly in history. So all these guys that are coming out, oh, we're going to have this gigantic crash. I'm like, how? You've got no inventory. Historically, we are in no man's land. We've never seen this before. So I wanted to touch on that. So here's Tom. It says, Tom Engel has lived off his portfolio for 40 years, no inheritance, no lottery winnings, just 9 years of savings from an average salary. How? He's a great investor with a brilliant cash management strategy. Here's how it works. Now, this is very much the strategy that I deploy. I would call these different. I would say buy bargains, but this is also a bargain up here if you're using a ratio. So what happens is you basically do this up and down movement sideways. It doesn't go up because this is just, what this is telling us is that we have inflation in the system. You've got this going up, and then you have an asset priced against cash or dollars. He says, buy the bargain of the asset versus build cash when it's expensive. The thing that you can do that's even better than this method here is you can use a ratio chart and you can swap between assets. So it's a ratio chart is an asset versus an asset. And the way when this goes up, one asset's outperforming one, you go into this undervalued asset, you come back down, you swap to the other undervalued asset, you go to the other undervalued asset, and you just go back and forth between two assets if this was a ratio chart. A ratio chart just tells you when an asset is cheap or expensive versus another asset. Now, we can do things on steroids as well. We can grab a gigantic amount of assets, price those assets against each other, all against each other. You could have like 10 different assets. You price, all 9 of them against, all 9 charts, because if you've got 10, it's 9 charts. And then you rotate and rotate and rotate, and then you find what the cheapest assets are, the sectors. Then you go bottom feeding in those to see how the fundamentals are changing and what the technical analysis is. That's what can get you the bottom that Michael Gayed was talking about, to buy those bottoms. That's how you do it. And you don't have to go to cash. You can just go from one asset to another asset to another asset based off the business cycle and the market conditions that the humans are trading under. So all you're doing is you're just front-running humans on how they're going to interact with each other. And you buy the cheap assets, knowing that under these conditions, money's going to rotate into that asset eventually. Now, you're not going to get everything completely right. You're not going to be perfect. No one's perfect. But you're going to get a lot of it right. And the symmetry of the risk-reward is so skewed in your favor doing this method that you're going to make so much money, it's not going to matter if you don't hit on everything. Your winners are going to pull that portfolio forward for you. So I wanted to touch on that. We can also touch on some of the other follow-on threads here. I'm sure he's got a couple of follow-on ones here if it determines to load. So he says, let's say Tom's portfolio is worth 100 grand in the middle of a bull market. Tom is happy with this number and he wants to protect it. He mentally calls this 100,000 his protected value. All his cash management decisions are based on this number. So he's got a portfolio value, the bull market, Tom's protected, 100. He says, Tom always keeps an eye on the macro and has an idea of how the market is, undervalued, fairly valued, and overvalued. Tom keeps 12% of his protected value in cash in a fairly valued market. So what he's doing is he's basically assigning these, and he's going to overweight the undervalued, underweight the fairly, or underweight the overvalued. He's going to overweight his investment in undervalued. He's going to overweight his cash position in overvalued, and he's going to be in the middle under fairly valued. So there's 12% cash. He says, let's say the bull market continues, Tom's portfolio continues to grow. He trims some of his holdings as valuations expand and his net worth grows. And that's what we do with ratios, is we divert cash to other undervalued sectors with time. And anyone who's part of the website knows that they say, well, when's it time to sell? I say, well, sometimes you don't go to the overvalued sector. You might come and ride all the way partially up, and you might invest in another asset that's down here and ride it all the way back up again. The only time I really sell is when I find something that is in that's better valued and a better asymmetric bet. And another time I would sell is if the market conditions change. So the market conditions have to change, or I find a better opportunity that I want to deploy money to. But this is a strategy where they build cash given one asset and the value of that asset. He says, let's say his portfolio grows to 130,000. Tom continues to trim, maxing out at 20% of the protected value in cash. At this point, Tom usually can't find any stocks trading at bargain prices. So they're only using one asset. You could also look at bonds if you're going towards a stock market crash. It says the bull market eventually ends, prices start to decline. Tom slowly buys his favorite stocks at better and better valuations as prices fall and valuations begin to favor buyers. This is also called dollar cost averaging in when you're trying to buy an entire bottom. I do deploy that strategy, and I use that using ratios, and I use that using technical analysis and how humans are interacting with each other. It says, Tom continues to buy as prices fall and valuations improve. Tom is okay with his portfolio value falling, even below his protected value. If that happens, he knows he's buying tons of bargains. Agreed. It says, let's say the bear market is really bad, like 2008. Tom's portfolio value falls to 70,000, well below the 100,000 protected value. At this point, huge bargains are everywhere, and his cash position drops to just 1% of the protected value from all the buying. Eventually, the bear market ends and the next bull market starts. Tom's returns skyrocket, especially from this bargain purchases when his portfolio was below 100,000. He slowly trims on the way up to rebuild his cash position. Within 3 to 5 years, his portfolio doubles to 200,000, powered by his bargain buying during the last bear market. He's happy with this number, so it becomes his new protected value. His cash balance target is now 24,000, 12% of the 200. Tom rinses and repeats for each cycle, which lasts 5 to 15 years. This 5 to 15 years is the business cycle. No, he builds cash when valuations are high, buys bargains when they're low, etc. Tom likes his strategy because it allows his cash position to grow at the same rate as my portfolio. The example above is an extreme bull-bear market. Tom's cash balance was only 1% once, and it's rare for it to be above 20%. Tom usually keeps between 5 and 15% of his protected value in cash during normal market fluctuations. I love the idea of protected value and this potential example. The way that I do it is different than what he's got. I'll actually deploy my cash value, or my cash position is generally precious metals, is the way that I view it. I don't really hold cash because Ray Dalio says, cash is trash. That's what I believe. I think it's always going to go down. So I use ratios to find the value in the market, and I don't have to go to cash. I can just go to other assets. Assets perform differently under certain market conditions, and under inflationary environment, what could potentially be in favor, I should say, is precious metals and commodities. You ride those up, and as you get towards the top and valuations get expensive, you can swap into bonds. Bonds would be another spot that you could be at a top of a market. So when interest rates were to crash, your bonds will go up in value, and it'll give you more oomph to the portfolio. Then when we bottom out, and if it's a housing market crash, if it is a housing market crash that caused that crash to happen, then stocks in a disinflationary period are going to do very well. Then you want to load up on stocks. You want to load up on particularly technology stocks or whatever other stocks like insurance companies, health companies, things that have fallen off their highs. It could be Visa, MasterCard, Chipotle, whatever it is, retail stuff. And then you ride it up for the bull market until it becomes late stage, and then you go back into the business cycle. We have an inflationary kind of ending to it that generally lasts 5 to 10 years, and you just do over and over and over and over. You rinse and repeat exactly what he's saying. I just do it with assets. You don't have to go to cash. You can go to another asset. You can go from oil directly into bonds. Bonds will go up again. You don't have to go to cash, and then when you hit the crash at the bottom and bonds are fully priced because interest rates have fallen and they're going to try to reflate everything, then you get in the stocks. It's the same method. And but I'm gonna end it there, guys. We've gone through quite a bit already. Lots of good information there. And if you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't done so already. And definitely try subscribing to the website, join our community. I talk a lot about where we are in this cycle. I talk a lot about ratios. I talk a lot about potential investment opportunities. Obviously, I can't give advice on a one-on-one basis or anything like that, but you can see what I'm doing. You can see my portfolio. You can see how I'm playing the bull market, what I'm investing in. I give updates on what I'm adding to in my portfolio. And I also talk a lot about the difference in particular investments. Are they cash flow, cash cows is what I call them. Cash cows are ones that are cash flowing, that are cheap in relationship to cash flows. Then I look at other companies that are more speculative. Think of the uranium sector. Great looking charts, great looking setups, but they're very speculative. So I don't put as much money into it. That's my opinion. Obviously, you can do whatever you want, but that's just been my kind of viewpoint on it. But I do talk about all this stuff, and it's worked out very well, I think, for a lot of the members. And I think they're pretty happy with a lot of the companies that I'm bringing up, and they're actively participating in them. That's what they choose to do. And what's happening is we can get these very cheap sectors with a lot of good opportunities that are very low, and then we use the technical analysis to try to get the bottom of the bottom. And some of them do require patience. They're not things where you're going to get rich in a month or two. Sometimes they do very well pretty quickly. Sometimes you have to be a little bit patient. And the risk rewards are very skewed in our favor at those bottoms. And you have time to kind of accumulate these things and cost average in. It's not things where we're buying them mid-stride and they're already kind of moving. So we've had some really good successes. 500-600% gains in less than a year. We've got some of them, not all of them. And it depends how you weight them and how you do it yourself will determine your potential returns. We've had a lot of companies go up 40-50% to about 150% this past year. We've hit up a lot of the energy service companies. That's kind of where we're hitting it up. And we're taking particular names and looking at them. There's also, I think, some good opportunities coming up ahead of us in uranium. The charts are looking pretty good. And the oil and gas sector is also looking quite tasty right now. And I think natural gas is going to start putting in a bottoming process and start to grind higher eventually over time. But that's what I've got for today, guys. Hopefully you've enjoyed it. We'll catch you next time. This is Finding Value.